Hello and welcome to this podcast where we're going to discuss the challenges of managing cash in Africa. I'm Sarah Rundell from Treasury Today Group, and I'm joined by Marion Reuter, Standard Chartered's Regional Head of Transaction Banking Sales in Europe, and Desiree Perez, Head of Corporate Sales Financial Markets, also in Europe. Talk to any multinational doing business in Africa and the chances are they'll say it's tough. None more so than managing cash and initiating payments across 50 countries and 40 currencies in a landscape characterised by FX and local currency controls, dwindling hard currency inflows, and a raft of costs and inefficiencies that bring a new level of complexity to working capital optimisation. But there are solutions, and Marion and Desiree are here to both flag the potholes and discuss how Treasury teams should approach cash management to tap all the opportunities the continent offers. So, Marion, could I come to you first? Could you broadly describe the main challenges around cash management for corporates operating in Africa?
Sure. Thank you, Sarah. Yes, Africa is a key region for us, and we work a lot and advise our clients a lot on what they can do in Africa. It's an up and coming region, I would say, from a treasury perspective. Why is it? It's a very complicated region. So when our European corporates have started to centralize their processes, they started in Asia. And now they are more and more looking at Africa as well. But when you look at the landscape in Africa, it's very regulated in terms of countries. Even South Africa, which we consider as the most open country, actually isn't when it comes to liquidity management. So there are still currency controls, and you can't just simply move funds out or even open a non-resident account for a European entity. And the regulatory updates and changes are happening very, very regularly. So it's important you stay on track with all the changes there, and you ideally have someone in the region who is close to the regulatory changes and can help the companies to navigate. So we as a bank also stay very close to the regulators, have people in the countries locally, and can also help and advise our clients around this.
Mm-hmm. It would be helpful to have some background on currency controls in Africa and explain the impact of currency controls on corporates operating in Africa. Desiree, could you take that one?
Hi there. Yeah, thank you, Sarah. So maybe just on currency controls, I'll talk a little bit about what these are and where they come from. Many African jurisdictions will have country-specific exchange controls. So these are things typically implemented by the central banks, and they're aimed at kind of regulating, inward and outward capital flows. So we do often see these in countries that may be experiencing foreign exchange shortages, as an example, which in turn can create liquidity scarcity. Controls can take a number of forms. They could mean that central bank approval is required for cross-border flows. It could mean additional documentation, restrictions on certain types of transactions, or priorities in terms of allocation of liquidity. So, I think the challenges that a typical corporate could have, especially an international one operating in these markets, is it can have consequences in terms of their ability to access cash in country. So this is the trapped cash issue that we hear quite often. And that's, things like their ability to extract dividends, or even simply just to make payments for goods or services in country to the extent that there are foreign currency invoices involved. And I think most importantly, it can also consume quite a lot of time and effort in terms of understanding and keeping on top of all of the various developments and protecting from a risk management perspective balances in the business. So yeah, those were some of the challenges I think that I would flag as well.
Oh, brilliant. Thank you. And Marion, could you add a little more about the consequences of these inefficiencies on Treasury?
Yeah, I think the main thing where our clients start with is getting visibility on what accounts they have across the different banks and what liquidity they have sitting. But then when they move on, right, they want to get these funds out from the African countries, and that's where the issue starts. It's usually trapped cash in most of these markets, and then the next solution could potentially be to at least have it in a currency that's a little bit more stable or on a head office treasury entity. But there, as I said earlier, there are also restrictions, even opening non-resident accounts. So we often go in a full 360, right, on what's actually possible. In some countries in East Africa, we are a bit more flexible. So there we can actually look at liquidity structures. And there are also the monetary zones with the XAF and the XOF, which you have as currencies where you can do certain things, but it's also not taken off in a way as we have it in the euro or in the dollar, as you still have restrictions, what you still need to do in the different countries, despite having one uniform currency.
Okay, so we could talk a little bit more about the solutions then. So Desiree, could you talk about, can corporates hedge this risk? Is that an option?
Yeah, so maybe, just to kind of touch on one of the points or one of the impacts on this. So from a currency perspective, the big risk, if you have got these trapped cash issues, is that we've seen depreciation in a number of these markets, and in some cases, very significant devaluations. Of course, that just erodes the value of that cash that might be trapped in country. So yes, there are ways to mitigate the risk. Now, whilst traditional FX markets may not be available in all countries, so for example, not everywhere will have a liquid forward market, in some cases not even a liquid spot market. But what we are seeing increasingly is non-deliverable markets. So a number of countries will have NDFs quoted, which can be used to at least economically hedge an exposure. And interestingly, we're also seeing growing use of FX options in an FX option market for some of these countries. And that can be actually relatively attractive from a cost perspective, especially when you think about the currency moves that we've seen in reality. I would say more fundamentally, away from your traditional FX hedging routes, longer term companies can or do also consider their agreements with their suppliers or with their customers. So things like the invoice currency that they're stipulating for payments or sales, maybe keeping that in currencies that reduce the risk of having a foreign currency need, or that offset each other to reduce the kind of net exposure and minimize the potential for trapped cash issues in country. So those are some of the more longer term solutions that people can think about.
Oh, brilliant. And to what extent does working with local banks increase efficiency around cash management? Desiree, have you got some thoughts on that?
Yeah, so certainly on the cash management side, I'll defer to Marion, who'd have the expertise there. From an FX perspective, I would say that it can be helpful having a few different banks to source liquidity from. Although what we would find is generally a mix of perhaps international and local banks can work well, because there are pluses and minuses of both. But in certain cases, yeah, just having more than one counterparty can help.
Yeah, absolutely. And here cash and liquidity and FX is very linked, right? As FX is scarce. So that means every bank has a certain threshold or ratio that they get from the central bank. So if a company happens to only work with one bank in the country, they only can leverage that one ratio. And no matter how good that relationship is with the client, we can't give them the full thing, right? We need to distribute to various clients what we get, and we need to prioritize, right? So if they work with various banks, they get a part of that ratio from various banks. That's likely helping them on getting or obtaining foreign currency. From a pure cash management efficiency perspective, it's of course always better to work only with one bank, right? As working with various banks, it's difficult to keep the overview what you have. They also have different account statements that they need to bring into one system. And across Africa, it's not a simple SWIFT MT940. Some local banks are not even on SWIFT, so they could not even share proper account statements for them to manage. So that's one of the things to manage for them. But I think it's unavoidable in an Africa that we have today with all the currency challenges to purely work with one bank. So local banks are inevitable, I would say.
Yeah, and actually, listening to Marion, one more point I would actually also add is in certain markets, you do have to be a little bit cautious about engaging too many banks. So what I'm thinking of is where there is perhaps a priority in terms of allocation from an FX liquidity perspective. This is where maybe it's managed by the central bank. Having many banks bidding on your behalf can sometimes move you lower down the priority list from an allocation perspective. So it is just something to think about in terms of how you engage, and why, again, it becomes a little bit specific to each market.
Okay, and what about technology helping efficiencies in cash management? Have you got some thoughts there, Marion?
Yeah, I think what we see more and more is, of course, our clients have all treasury management system or ERPs that they are using for the visibility aspect. Centralized payments for Africa, hardly anyone is doing, as it's too restricted to do payments on behalf. But purely from a visibility perspective, it's possible to bring accounts across different banks into one system. But as I mentioned earlier, if you work with very local banks, especially in Central Africa, these banks might not even be on SWIFT, or might not be even able to send a structured MT940. So a treasury system could not even pick up the information from the right places to help them in a central reporting. So yes and no, I think, is the answer. It helps, but it's also not perfect. It's just not as advanced as you would have it in other Western markets or across Asia.
What I would maybe also add there is absolutely agree with what Marion says, and that there are constraints in what can and can't be done. But I do also think that to a certain extent there are some digital solutions that are probably underutilized by companies typically. So there are ways that you can, for example, automate cross-border currency payments, including ways to digitize documentation requirements, which can be a big help in certain markets. And that can really help to reduce the administrative burden for a typical treasury. So I think that's something that certainly, especially as Africa is increasingly becoming more and more advanced on the technology side, I think that's something that should be on people's radar.
Oh, yeah, no, good point. And are there any key points around the pros and cons of centralized versus devolved treasury functions when it comes to managing cash in Africa?
Yeah, I think this is indeed a very, very popular topic, and part of every conversation we are having with existing clients and new to Africa clients, I would say. And it's also, I think, the main topic at any conference that evolves around Africa. We see a bit of an evolution and also a little bit of a back and forth around this, while many central treasuries have realized they need someone on the ground in Africa. They do not only want to rely on country by country people, as very often when you have a small setup in a country, you cannot have a finance and a treasury person. So you end up with more finance than treasury people. And then it's not necessarily coming together strategically what you want to achieve, as the perspective is a very different one. So what we see more and more evolve is regional treasury centers also for Africa. And interestingly, in the past, they mainly were in South Africa. We now see more and more Africa and Middle East coming together, and Dubai evolving as a hub for regional treasury centers that manage Africa. As logistically, it's quite connected in terms of flights, how you can reach Africa from Dubai. And from a workforce perspective, you have a very international talent market. And that's why Dubai is also evolving. So I think the best solution that we see is a bit in between, not completely central, as you need to be close to the market and the developments, but also not completely local. And that's where the regional treasury centers are more and more evolving for Africa among our MNC clients in Europe.
Oh, wonderful. Thank you so much. Desiree, any final thoughts on that point?
Yeah, no, so what I would say is, from an FX perspective, actually, it's maybe a little bit, I would echo what Marion's saying, in that it's a combination of centralized and devolved. There's always going to be a need and a very important role for the local team, especially because there will be documentation requirements, potentially central bank approvals. So someone close to the ground there needs to be aware of that. But equally, from a central treasury perspective and a headquarter perspective, having that oversight of all of the markets and potentially being able to take decisions on which risks are material enough to manage, how to manage that, how to look at it in the context of a group as a whole is also very important, and maybe to leverage group-wide relationships as well. So I do think that it again, it's not one versus the other, but yes, I think that that it's important that both are very closely aligned.
Marion and Desiree, thank you so much.
Thank you very much. It was a pleasure.
Really enjoyed it. Thank you so much, Sarah.
What a great discussion. You've been listening to Marion Reuter, Standard Chartered's Regional Head of Transaction Banking Sales in Europe, and Desiree Pires, Head of Corporate Sales Financial Markets in Europe. I'm Sarah Rundell from Treasury Today Group. Thank you for listening, and if you'd like to hear more of our podcast episodes, please subscribe wherever you get your podcasts from.